In this week's update, potential bottom forming in the US, megatrend areas to focus on, how we've played the correction, and what comes next. My name's Garry Davis, and as always, this is general advice, and please remember to like and subscribe to the video. Let's start with the usual market perspective, because there's obviously been a lot happening in the last week. I guess the first point I want to register is pretty obvious when you think about it, but sometimes we just get too close to the action, and there's just so much negative news at the moment that it's easy to forget that there's always opportunity somewhere. In some market there is an opportunity. And Australia has diverged very significantly in some sectors from the US and from other global markets. Now, part of that is because the US stocks, a lot of them were trading on such excessive multiples that they had a lot more to lose than we did. Our market didn't really ever get to those levels of excess other than in some areas like buy now, pay later, or some of the technology sectors. But largely we had less potential to fall, and so there's been some divergence there. But it has been most obvious in some of the megatrend sectors, and in Australia, the one that is most evident is around decarbonisation commodities, so copper, nickel, lithium, graphite, etc. And those stocks have tended to remain quite resilient. In fact, some of them have continued to trend upwards while we've been during this corrective phase. So there's been very substantial divergence there. And we've actually started doing some buying in recent weeks, despite the fact that I've had a cyclical bear market stance, certainly on an introductory level from December, but certainly from January onwards, I've been, quite emphatic about the fact that I thought the US market would continue to fall for quite a few months. But despite that, there's always opportunity, so we have been doing some buying. So that's the key thing. You don't need to pull the covers over your head and go and hide somewhere. There has been opportunities. So let's just do a quick recap on how we've played the correction. And when I say we, I'm talking about myself and the members of Specialist Share Education. Now, we started cashing up to a degree in December in a bit of a preliminary way. But as the signs became more confirmed during January, we did that more so, and particularly in America. They were the holdings that I felt were most at risk, and so we cut the American portfolio down very, very significantly. And it's worked out pretty well. We've saved ourselves a great deal of pain by getting out of those US positions, taking profits in most cases, or taking a few small losses in other cases, but just get out of the way and cash up. Now, locally, when we go into corrective phases, inevitably small caps get hit harder than the rest of the market. And so we certainly cut back on some small caps. We also cut back quite significantly on some stocks that had run very hard, that had gone up many, many hundreds of % and looked really a bit overdone. So we cut back on some of those as well. And then as the corrective phase progressed, there were various stocks that were breaking support. So, we just progressively cashed up, slimmed our portfolio down. And it was really just an observe and respond approach. I didn't take any predetermined ideas about how things were going to unfold. It was just watch what the market is doing, watch what individual stocks are doing, and respond accordingly, just looking at managing risk. And in phases like this, you've got to get rid of the ego, you've got to get rid of the need to be right, which I still see a lot of, judging by the questions and comments that I get. And you've just got to get over that, because there's no place for it in the market. If you're hanging on to the need to be right, then the market's going to slice and dice you every single time. So that's a really important aspect of how you deal with these sort of corrective phases. So we ended up paring back and holding smaller portions of high conviction stocks, ones that I'm just, as good as certain. There's no certainties in the market, but I was as good as certain that these stocks were going considerably higher over the next 6 months, 12 months, 2 years. And so then it's really just a matter of moving back to a level where you can accommodate the volatility. So it was really an exercise in managing psychology. And from there, we've just waited until opportunities started to present, and done nothing in America. I've done a bit of shorting in America, that's about all. But in Australia, we've started buying in recent weeks. So what does the rebuild process look like? Well, first of all, you've got to have really strong clarity around your targets. They've got to be stocks that you feel confident have got a really, really high probability of being significantly higher in the future, because the business is just going to grow, and it really doesn't matter what the rest of the world does. It doesn't matter about inflation or wars or whatever. The price is going to go up because the business is rapidly getting bigger and better. The next thing you need is a bit of a sense of where some likely good entry zones are, and you don't necessarily need to go all in at a particular level on the hope that it works. Again, process is important. So what I've been doing and what members have been doing is just to build progressively partial positions, put some orders in the market at likely support levels, and just wait a few days or a few weeks. And as it's turned out, most of them got filled at the end of the day, and got filled at very good prices. Now, if that didn't turn out to be the good price, then we're only buying a partial position anyway. So we were hedging our bets. But as it's turned out, nearly all of them have since rebounded. So it's actually worked out quite well. So the process we're using in Australia has been very productive. And even a couple of them are setting new all-time highs. So there really are some strong trends in Australia, despite all the turmoil and uncertainty overseas. So what comes next? Well, we really need a process, I believe, to accommodate another leg down in America. Whilst it's possible that we've seen the lows, but I'll have more to say on that in a slide or two, it's possible we've now seen the lows in America, but I'm not embracing it yet. So I'm still leaving the door open to another leg down in America. And so the process of rebuilding that you use really should accommodate that. You shouldn't be going all in with the expectation that it's the corrective phase is finished. So I think that's the most important thing, because there's still a potential for another smack to the cheek in America. And if the market does go down another leg in America, then it's just going to set up even more compelling entry opportunities. So yes, that might shave a little bit off some of the partial new positions that we've taken, but look, these are long-term high conviction stocks anyway, so it's really, you just got to ignore it for that short period of time. All right, the American market was up 6.2% for the week, so it was a very, very robust market. But before we get there, I just want to look at a few key charts. So I want to address this issue of divergence between the US market and the Australian market, and the fact that there are always opportunities if you're organised and you're focused on what you're doing. So I just want to roll through some ETF charts first of all, then a couple of stock charts, and then compare them with some of the Megatrend large cap stocks in Australia. Not that I'm recommending that, these stocks aren't recommendations. These are merely examples to show the difference in the trend. So what I want you to observe here is the red line, which is the 200-day moving average. In this case, it's rolled over. And then we've got the blue and the green lines, which are shorter term moving averages, the 50 and the 20, and they've obviously rolled over to a much greater extent. So when you look at this WCLD, which is an ETF covering cloud computing stocks, the broader part of that market, then you can see this is a very, very strong downtrend. Let's look at XLY, which is consumer discretionary, another aggressive sector that's been sold down quite hard. Now, notwithstanding what's happened in the last 2 or 3 sessions, which has been quite strong, but again, just look at the moving averages. The shorter term moving averages have all rolled over. They're pointing downwards, and the price up until a day or two ago was significantly below them. XLK, the technology sector, another one that's been the worst performer. So XLY, XLK have been the 2 worst performers in America this year. And you can see from the moving averages, the shorter term moving averages have rolled over well and truly. That occurred back in January. And the price is really yet to regain the 50-day. But certainly last week, it put in a good performance, quite impressive. So that sort of, in my mind, opens the door to the fact that we may have seen the lows. But a bit more on that shortly. Now let's look at some other stocks. This is Google. Hasn't fallen as much as some of the others, so this is looking better. But again, we've been under the 200-day moving average pretty consistently since the middle of January, and we still are. Now just remember this chart, and this is one of the strongest charts in America when I get to some of the Australian ones. Now talking about the mega trends in America, I mean, I think everyone has a pretty good idea what the mega trends are and why they're important. They're important because they're going to continue no matter what else is happening on a month by month basis around the world, and there's plenty of negativity that you can point to. But inflation, wars, interest rates, deglobalization, whatever you want to look at, it's not going to derail these megatrends. It's not going to derail the move to cloud storage and data analytics. It's not going to derail artificial intelligence, machine learning, or automation and robotics. It's certainly not going to get in the way of decarbonisation, commodities and the processes. And I include, by processes, I'm also including electric vehicles. It's not going to get in the way of energy security. That's just become a massive issue now. And it's certainly not going to get in the way of critical strategic minerals, because so many countries now are realising that supply chains are really problematic, and that they've got to start to develop their own sources of supply and manufacture and not be reliant on other countries. So I think these are all the mega trends that are going to unfold over the next decade, and that can provide extraordinary profit-making opportunities. So that's Google. Microsoft looks something similar. The price still below the 200-day moving average. Hasn't rolled over yet, but the fact that the price has been underneath it is, makes a statement about the correction there. Amazon has had a pretty good last few days, last week as well. But again, the 200-day moving average has rolled over, and all the shorter-term moving averages are pointing down. But let's compare that now with Australia. This is Pilbara Mines, 200-day moving average, still moving up very strongly. The price still comfortably above that level. And again, just a reminder, these are not recommendations. This is just an observation about the divergence between the parts of the Australian market and the American market. Linus in the rare earths area, again, just look at the trends and look at where the price is relative to the bigger picture trends. IGO Limited, the same. And there's many charts that I could show that reveal the same sort of dynamic. So that's the key point I want to make there. There's always opportunities. You've just got to be attuned to where they are. Now, the American market, as I said, ended up 6.2% for the week. The last 3 days were really pretty impressive, which does, I'm quite prepared to say that we may have seen the US lows. However, my concern is that leading into options expiry, which was Friday, there was, because of all the concerted falls that had happened, there was an extraordinary amount of in-the-money put premium that was just begging to be manipulated by market makers. So I believe there is a chance that that has happened. And with options expiry now out of the way, we could see the market turn back down next week. Now, as you know, I'm guided by what the market shows us on the charts, and not by what I think. So I'm not being guided here by what I think. All I'm saying is I want to beg for a couple more days just to see what the market will do once we get out of that options expiry period. So I think in another 48 hours, 2 more US sessions, I think I'll have a much, much better idea of whether the lows have been formed in America or whether there is another leg down. But if the lows have in fact been formed, then I'll be happy to be wrong on the forecasts that I've been making. And as I said earlier, we've already been buying in Australia anyway, so it's not like we've missed out. Now the US dollar was down to 98.23, not a great deal from the previous week. The 10-year yield has spiked up to 2.14%, so it's comfortably holding above 2% now. The VIX did ease back to 24. It had been above 30 for quite a number of weeks, which was unusual. But interestingly, the spread between the 10-year and the 2-year US Treasury yield continues to fall and continues to edge towards zero, which would mean an inversion. And what that means, for those of you that are not across that, it means that the shorter term bond rates in America, the 2% rates, would be going higher than the 10% rates. And history shows, this is not a guarantee, but history shows that when that happens, generally it's pointing to a future recession, which occurs generally within 6 to 18 months. And in a recession, it's not good for stocks. It's very, very difficult for stocks to go up in that sort of environment. So that's the relevance of that 10-2 spread. Now let's take a look at some charts. Right, we'll start first of all with. Sorry, just get rid of that. We'll start first of all with the 2-year yield. So we'll look at the 10-year yield. So we'll look at the last 3 months. So you can see we've moved from under 1.5, and we had a little bit of a dip in early March, but now we're comfortably above 2%. So clearly the 2-year yields are rising quite strongly. If you look at the spread between the 2 and the 10, so the 10-year would normally always, most of the time, is going to be higher, which reflects the cost of money. But you can see that we've moved down from around 1.6 being the difference between those two rates in this time last year, and we're now down to finish the week at 0.26. So edging down towards the zero mark. In fact, it's actually lower than that. It's 0.17. So that's certainly a chart to watch closely. The VIX, if we look at it over the last 6 months, you can see somewhere around about 15 to 20 is a normal baseline level. We had a spike in December, another spike in late January, and of course we've been quite elevated for the last little period up until last week. Okay, let's take a look then at some of the key spread charts, which are important. All right, so first of all, this is consumer discretionary versus consumer staples, and you can see this definite pickup in the last week. Consumer discretionary stocks, money started flowing back into them. So, that's why I think we may have seen the lows, because not only did consumer discretionary stocks have a very good week, but clearly money came out of staples and went back into consumer discretionary. Now, we've We've had lower highs all the way down, lower highs, lower lows all the way down. We've now broken a short-term high. But as I said earlier, I just would like to see 2 more sessions in the US just to get out of the effect of the options expiry, and let's just see where the market is sitting. It's only another couple of days. It's not going to make that much difference, and I think it'll give us a much better insight. The next one is the small cap growth versus small cap value. Bit of a kick up, as you can see, a little bit of money preferentially flowing back into growth, but nothing terribly dramatic. Doesn't change that one very much. This is the Russell 1000 growth versus value, so a bit more medium to larger cap stocks. Yes, we've had a kick up, but hasn't really violated the downtrend yet. So a couple more days we'll get more clarity on that. And this is the NASDAQ 100 versus the S&P. So clearly money flowing back into that area. But I'd have to say that Amazon had a huge turnaround. So that would be feeding into this to a fair degree. I just want to see if it's sustained over the next couple of days. So I guess that's where I sit at the moment in terms of the bigger picture. There's a chance that that we've seen the lows. But there's also a chance that that was just a temporary, manufactured for the benefit of self-interested groups kind of rally. So if we turn now to the actual S&P, you can see that we were forming lower highs, lower lows. We broke an important support level at 4265 to 4300. In fact, we broke it twice, and now we've rallied back very strongly and formed a higher high on a short-term basis. So certainly there is enough evidence there that you've got to take notice of it. You know, I can no longer say with conviction that we're still in a cyclical bear market. Or in fact, we didn't ever reach a cyclical bear market because the index didn't get down to 20% decline. So I just can't say that anymore, but I'll be clearer in a couple of days. Okay, turning now to the US dollar index, down a little bit over the last few days, but still clearly in uptrend. But the one really showing some surprising strength is the Australian dollar, and the Australian dollar is now forming new highs, and that's on the strength of commodities. So normally in a time of crisis, the Australian dollar doesn't do well, but in this time of crisis is associated with very high commodity prices, so it is actually doing a lot better than would normally be the case. All right, Australian stocks, 73.49 is where we finished. Our index was up 3.3% across the week, so did quite well. And many sectors have shown good strength, but really when you look at where is the real strength, it's the megatrend related stocks. The mining stocks across all those various areas is really the place to be at the moment, in my view. Precious metals, gold fell by $68 down to $19.18. So how quickly that's come off a big double top, and it's been a very, very strong 2-week reversal. And I've been saying now for a long time, gold is just extremely hard to catch at the moment. As we'll see on the chart in a minute, sitting on key support, but support and resistance levels in gold have just been unpredictably being broken in both directions. So I don't have much confidence about the near term or even the medium term direction of gold, to be honest. Precious metal stocks, they outperformed a little again in the short term. Bearing in mind they've been underperforming gold for a decade and a half, but just in the last few weeks we've got some short-term outperformance. So let's just take a quick look at those charts. So this is gold on a daily basis. So you can see we've had some very concerted selling. Once we got to that big double top that we'll look at on the weekly chart, we had very strong selling on the 9th of March, again on the 14th of March and the 15th of March, and you can see at one stage we were down quite a lot. And interestingly, we came down to the 61.8% Fibonacci retracement level between this low here in early February and the peak. The fact that it's managed to dip so deeply on a Fibonacci basis tells you that the trend upwards was not as strong as it looked. In other words, there's a lot more concerted selling on the downside. So I would now expect the odds favour gold just really going sideways in some sort of volatile fashion. You can see it more clearly on the weekly chart, where we're now at the support provided by the peak in the early part of June last year. So yeah, really, I just don't have much of an opinion on gold at the moment, I'm afraid. And if we look at GDXJ, a little bit stronger than gold in the last week, but has been unable to close above this key resistance level. So gold stocks not really picking up the slack yet either. So turning to other commodities, copper and nickel have certainly been in the news a lot. Copper back up to 465. Nickel traded, I think, might have only been a part of 1 hour on the London Metals Exchange, and again they obviously still haven't got their processes sorted out, because it went limit down and was immediately suspended again, which was a 5% drop. So nickel's still in suspension at 1669 until they can sort out this potential time bomb from a Chinese company being short nickel to the tune of about 180,000 tonnes. So when the price of nickel hit $100,000, they were in severe trouble. And the nickel saga really raises questions about how some of these opaque markets like nickel and like gold and like some of the commodity markets how they actually function. They're all sort of clouded a bit in a bit of mystery, and no one really understands exactly how that price discovery process gets set. Crude oil got up to 120 plus on West Texas Intermediate last week or the week before, but has eased back to 105. And it would seem that the worst of the response to the Ukraine invasion has perhaps occurred now, and things are starting to settle down. But the International Energy Agency says that already tight oil markets are really going to get worse, and they were fairly emphatic about that, about the balance between supply and demand. And there are forecasts now starting to appear. I mean, this always happens, but there are forecasts starting to appear for oil at $200 a barrel. And when you look at the long-term supply and the underinvestment, the whole decarbonisation process, and now the fact that we've got this Russian oil now taken out of the market, it's pretty hard to argue that $200 a barrel couldn't occur. Maybe not tomorrow, maybe not next year, but everything is sort of pointing in that direction. There's the spot copper chart. So a bit of a rebound last week, and nickel, after that big surge a week and a half ago, is really just flat and in suspension. So to wrap things up, the world is changing very rapidly, and in ways that we remotely didn't expect even just a few weeks ago. I mean, before Russia invaded Ukraine, it just didn't seem like it was something that was going to happen. And so we've now got these huge inflation numbers, partially caused by the invasion, but partially were always going to happen anyway. But I'm still of the view, as I've been saying for several months now, that as the inflation numbers from 2021 start to come into calculation, the higher numbers in 2021, that the relative rates will start to moderate, and that all this inflation rhetoric will settle down, and people will stop agitating for dramatic rises in interest rates to deal with it. So I just think perhaps the worst of some of these things has been priced in. It still doesn't mean that the big picture multiple contraction that's underway in America still hasn't got further to run. And in fact, I think in some areas it does. But overlaid on top of that was some of these other shorter term issues. But the key point I want to make here is that investment plans must be different. We're in such a different world. We've been in a world that was going global in terms of supply chains and trade policy for decades and decades, and it would now appear that has changed. It also would appear extremely likely that a 4-decade bear market in yields or bull market in bonds has reversed. So when you've got those really, really big picture changes, the world is going to be a very different place from here on in. And so I think investment plans must be very different as well. It's just illogical to expect that what has worked over the last 4 or 5 decades is going to continue to work. So doing the same old in terms of the conventional thinking about how you should diversify a portfolio and have a bit of this and a bit of that, I just think is madness, frankly. I think you've got to rethink it. You've got to get focused on the megatrend areas, which gives you the probability that no matter what comes along, the companies in those areas have got a tailwind. And, that's what you want. You don't want to be caught in old world companies in a rapidly changing world. So in that sort of environment, everyone needs the best possible information and perspective that you can possibly get. And I've outlined the strategy that we've been employing in far greater detail in a recent video that I did a few weeks ago, which was called How to Profit from a Market Correction. There's a link to that video associated with this one. So if you haven't seen that, I would certainly recommend you have a look at it. And yeah, again, it's just so important that you keep your perspective sharp. And if you're being guided by what you're reading in the media, then you're definitely on the wrong track. We all need to get our heads out of the daily turmoil of what the market is doing and what the media is saying about inflation and about the Ukraine war and how they're going to deal with Russia. You just got to get away from all that and think and act very clearly and very decisively with a clear plan. And unless you can get to that point, I think you're going to continue to struggle in this market. Portfolio analyst last week, we looked at planning the structure of your portfolio, what you want it to look like in 6 or 12 months' time. And, that's just a key first step. If you don't know what your portfolio should look like, according to the criteria that are important for you, then how can you make a decision about buying any stock? Because you don't know whether it fits or not. And so many people just buy stocks based on a whim. They read something that sounds appealing and they go buy it. And they don't stop to think about, is that the sort of asset that should be in their portfolio? We also looked at my high conviction targets, both in America and in Australia, and the buy prices, potential buy prices around those. Now, if you want some help with the execution phase, with choosing stocks, with choosing entries, with strategy, with managing profits, all those sorts of things, then Portfolio Analyst is a heck of a good place to start. There's a $1 trial available for 2 weeks if you haven't availed yourself of that. And I think it's something well worth doing because, most people don't have the time to put into the market that I do and therefore be able to retain the sort of perspective that's important. So that's it for this week. There's more information on the website. There's my email address, and I'll be back with you next Sunday. Cheers.